Michael Farr is here with us on how to position. Michael, welcome. We're going to start with some semis, which are taking a hit after China has reportedly urged local companies to stay away from Nvidia's chips. Nvidia shares are now down about 1%. They were down 3% pre-market. Not a big reaction, Michael, but what would you do with those Nvidia shares here?
Yeah, we don't care about really what China's doing right now. And I think that the report by Kate was probably as important as anything on the regulation of the AI. NVIDIA is a great company, and for now they're growing earnings at 40% per year, and they're 40 times earnings. You get a chance to buy NVIDIA on pullbacks because the market is doing the same stupid thing with NVIDIA that the market does with the Fed. They want it to be bigger than it is. They want these great earnings reports to even be better than they are. And when they come in only great and not greater and greater, the market, that stock trades off. So every time there's been an earnings on NVIDIA, you've had an opportunity to buy it at about down 15%. I would wait, but I think it's one you probably want to own for a while. I've got it as a buy. Same thing with the Fed. When they actually do what they say they're going to do, markets get disappointed. I wish markets would listen.
The stock of Nvidia has been soaring. The company's stock has increased by 145% so far this year, outpacing the gains made by the S&P 500. This mega-cap stock is performing beyond expectations in the long run. Over the last 3 years, Nvidia's share price has surged by 487%, and over the last 5 years, it has increased by an incredible 2,740%. In spite of this phenomenal increase, Nvidia's long-term pricing is still appealing. For a premier IT business, the stock trades at 28.5 times estimated earnings for the fiscal year 2027, which is reasonable. Investors have openly questioned if Nvidia can maintain its current level of success. These are 3 strong arguments for why the chipmaker's stock is still a great option for buy and hold. First and foremost, remunerating shareholders with buybacks and dividends. Nvidia has proven to be quite dedicated to giving shareholders their money back. In the second quarter of fiscal year 2025 alone, the business repurchased 62.8 million shares for $7 billion, as per its most recent 10-K filing with the Securities and Exchange Commission. As of August 26, the total amount available for share repurchases at Nvidia was $53.9 billion, as the board recently approved an extra $50 billion. This hefty buyback authorization reflects management's confidence in Nvidia's long-term prospects. Earlier this year, the company increased its quarterly cash dividend to $0.01 per share on a post-stock split basis, although most shareholders normally overlook it due to its pitiful yield of 0.03%. Even though it is modest, this rise demonstrates management's dedication to rewarding devoted shareholders. These capital return programs show how dedicated Nvidia is to generating profit for its owners. While many high-growth tech companies completely skip dividends in favor of reinvesting in the business, Nvidia offers investors many routes for return on investment through its combination of aggressive share repurchases and continuous dividend increases. Riding the AI wave is the second reason. Nvidia is in a great position to benefit from the explosion of artificial intelligence, AI. For AI and machine learning applications, the company's graphics processing units, GPUs, are the industry standard. This supremacy is evident in Nvidia's data center revenue, which is enjoying tremendous growth. Industry insiders believe artificial intelligence will revolutionize the world economy. By 2035, AI is expected to double the yearly rates of global economic development, according to consulting giant Accenture. According to PricewaterhouseCoopers, the adoption of AI might boost the world economy by up to 14% or $15.7 trillion by 2030. Nvidia is leading this revolution in AI hardware technology thanks to its technological supremacy. Large language model training and the operation of AI-driven applications across industries depend heavily on the company's GPUs. Nvidia is poised to profit from a rise in demand for its specialist hardware as AI adoption quickens. Reason no. 3. Growing expansion of data centers. According to Nvidia CEO Jensen Huang, AI interactions on the internet will be powered by millions of GPU data centers in the future. This idea is quickly coming to pass. Large big businesses are buying GPUs at a rate that is significantly higher than ever before. Microsoft, for example, plans to triple its GPU supply this year to 1.8 million units. Giants in the tech sector are doing the same. 150,000 H100 GPUs were ordered by Meta Platforms last year, and 350,000 H100s or equivalents this year. Further boosting demand is Elon Musk's Tesla and X, which are both making significant investments in AI infrastructure. Experts in the field predict even more significant expansion. By 2027, Broadcom anticipates million GPU clusters as opposed to today's clusters with tens of thousands of GPUs. Lisa Su, CEO of Advanced Micro Devices, projects that the market for AI accelerators will grow to $400 billion by 2027. By 2027, NVIDIA might be able to cash in on a $320 billion data center business thanks to its overwhelming market position. To put this into perspective, NVIDIA is expected to produce data center revenue in fiscal 2025 of between $106 billion and $121 billion roughly.
Serious note, let's get back to the note. You're seeing a lot of upside for tech in Q4. You actually believe that tech can move another 10% in Q4. What's the catalyst?
I mean, look, this is our second trip in Asia in the last 6 weeks. Demand's outstripping supply 15-1. So even though right now it starts with Godfather of AI, Jensen, NVIDIA, this second, third, fourth derivative, it's just starting to play out in terms of AI. I think that is going to be the catalyst to tech stocks being up 10% plus this year, 20% next year. I think the AI party, still 9 p.m. with a party that doesn't end until 4 a.m.
Why does the party end at 4 a.m.? I mean, I don't even, this metaphor always cracks me up every time you do it. But on a serious note, you're saying demand is up. That's what's going to push the tech sector 10% more in Q4. Demand exactly for what? For chatbots? For chips? I mean, what is the real catalyst here?
I mean, if I look from a chip demand, 15-1 demand to supply. So if you see how it's all playing out, enterprises are lining up in terms of the AI revolution. Now we're just going to start to see the software, the use cases. That's where Messi of AI, Palantir, front and center. You look at names like Oracle, what I believe Salesforce.com, ServiceNow. So now that tidal wave of spend, $1 trillion of AI CapEx is coming to the shores of tech, to me, in the next 2 to 3 years.
By the way, I interviewed Alex Karp a few weeks ago. We talked about you. We talked about you and some of your notes. He's a fan. He's a fan. I want to get to some more of your note. According to your note, for every dollar spent on NVIDIA chips, there's an $8 to $10 spend in the tech sector. So I want to drill down on that. Is it in the tech sector or is it on AI capabilities? Because we just talked about utilities having their best quarter, since back in 2003. Isn't a lot of this spending on just physical infrastructure? Is that technically tech spending?
Sure. I think 8 to 10 is going to be from software, infrastructure. You talk about the energy piece. It speaks to our view that it's not just about NVIDIA. It's not just about Microsoft. It's now about the multiplier. So what you're going to see really across software, I think the big catalyst going to tech over the next 12, 18 months, numbers are going to go up, I think, 15, 20% across the tech sector. And I think that's why a lot of the bears that are continue being those caves and hibernation modes, they come out talking about valuation. I think streets underestimating growth. That's why, in my opinion, this tech bull market still in the sector.
Mizuho's semiconductor and hardware experts in Asia have increased their 2025 projection for NVIDIA's AI GPU units, citing higher than expected growth due to increased production capacity. The analysts updated NVIDIA's total 2025 AI GPU shipments by 8 to 10% higher than its July 2024 predictions, citing important supply chain improvements, especially in CoWoS, chip-on-wafer on substrate technology. According to the study, NVIDIA plans to ship 6.5 million to 7 million units in 2025, of which 3 million will be CoWoS S GPUs. The Hopper and Blackwell models will be mainly among them, with CoWoS S achieving a yield of more than 99%. Furthermore, it is anticipated that CoWoS L, a different NVIDIA process, will generate 3.8 to 4 million units, mostly to support the GB200 server racks, which are in high demand. This product line will receive 80 to 90% of the process's production. As Taiwan Semiconductor Manufacturing, a major NVIDIA production partner, doubles its yearly wafer capacity, Mizuho has updated its projection. We expect the scarcity in CoWoS supply to persist into 2025, but project progressive recovery with an estimated annual wafer capacity of above 650,000 coming online at TSMC next year, up 2x YoY, the note adds. The supply-demand situation is anticipated to gradually improve, and some back-end, on-substrate procedures are anticipated to be outsourced to advanced semiconductor engineering in addition to boosting front-end, chip-on-wafer capacity. Experts argue that investors' worries about possible delays in the Blackwell GPU deployment have been overblown, citing TSMC and SK Hynix Incorporated's projected sales rise after the Blackwell GPU launches in the fourth quarter of 2024. Overall, delays in semiconductors, such as AI GPUs and ASICs, are not anticipated to have an influence on the manufacturing of AI servers in 2025, according to Mizuho's Asia hardware and semiconductor analysts. They also stated that Taiwanese back-end equipment vendors, such as Alring Tech, are expected to gain from TSMC's vendor localization efforts.
But I think that so far, you look at NVIDIA, it's rallied 145% this year. There's all these concerns with some of the recent, it feels like pullbacks that are just, temporary, but still notable. That there's all these concerns that like the AI narrative has right now burst or the bubble has popped. I don't think that's true. I think that 64 analysts cover this name right now. You have 94% at buys or overweights. And I don't necessarily see some of these dips as necessarily bad things. If anything, they're opportunities, because if you can see from the recent dips, we've seen shares then recover almost back to all-time highs every single time. So some of these pullbacks, I think, are necessarily healthy for a name that's been up, again, 145% on the year.
Yeah, but I think it's important to note that NVIDIA can't sell its most advanced AI chips to China anyway. So this seems to really underscore that China is still a big market for NVIDIA, given the fact that shares are down on this news.
That's also a good point, because I do think there's like a lot of speculation, but also just anticipation for like what the next leg of Blackwell looks like, and their various chip, iterations that are coming in the next couple of years, because obviously they have to keep up with this promised demand, which is the whole reason shares are even up 145% this year. So I agree. I think this is a story that's actually been maybe underlooked for a lot of this past year, but especially in names like, these restrictions aren't necessarily specific to NVIDIA. Other names like AMD or some of these smaller suppliers that are more largely exposed to China, I think that's where there's actually really trouble.
As market players evaluate whether more interest rate reductions are necessary, the state of the economy currently offers a variety of signs. The Fed has indicated that rates may be lowered despite the general strength of the economy because of problems in particular industries. The U.S. dollar is depreciating vis the euro, which is causing a change in currency dynamics and further complexity in the financial environment. Major stock indices, such as the Dow Jones, are still hovering around all-time highs against this backdrop. Even with the anticipated market volatility leading up to the midterms, Stephanie Link, chief investment strategist and portfolio manager at Hightower, thinks the Fed is deftly steering the economy toward a gentle landing. Oppenheimer Asset Management's John Stoltzfus came to talk about the impact of the Fed's most recent rate drop. It was noted that the S&P 500 is in a unique period as it recently reached its 41st record closing of the year. The chief investment strategist at Oppenheimer has set an index objective of 5,900, attributing this bullish outlook to the Fed's recent rate reduction. Numerous industries, including as gaming, data centers, professional visualization, and artificial intelligence, use NVIDIA GPUs. Revenue increased by 122.4% in the second quarter of 2025 compared to the previous year, primarily due to a 54% increase in data center revenue, of which cloud service providers accounted for approximately 45%. This growth was driven by a strong demand for networking platforms, GPU computing, and NVIDIA Hopper. The business anticipates $32.5 billion in overall revenue for the third quarter. The most potent AI training system in the world, Colossal, was introduced by Elon Musk's xAI firm. It is powered by H100 GPUs from NVIDIA Corp. H200 GPUs will soon replace them, and eventually Blackwell CPUs. Its expansions in healthcare are also present. With the aid of its AI-powered Clara platform, academics and healthcare professionals can now process enormous data sets with speed and accuracy for uses including data analysis, medication discovery, and diagnostics. A few days ago, NVIDIA AI-powered NetApp unveiled a new GenAI data vision and end-to-end integrated solution. The management projected that yearly data center infrastructure spending would reach $250 billion, with the potential to increase to $1.2 trillion in the ensuing 10 years. Large AI model training is requiring an increasing amount of processing resources. 3 frontier models, each with 50 trillion parameters, might need 20 million chips to train by 2027. Businesses that are at the forefront of inference and training include NVIDIA. For AI models to be profitable, inference will be essential. These elements demonstrate the company's ability to hold onto its place in the market.